Good morning. Well, just we got the power back. A nor'easter hits many of us in the Northeast, and we are again without power. So thanks to generators, we're coming to you. The weather's supposed to get better here. At least we hope so. Okay, the stock market, after looking like it was going to start up the day to the plus side, has reversed course. It's down just a little bit, and the opposite for bonds. Bonds started the day to the downside and have reversed course, and now are just a little bit higher. With respect to the news of the day, it's Thursday. Initial claims came out. Initial claims 355. No great surprise there. Last week was 363. But these numbers are going to start to become more volatile and a little bit more difficult to interpret because the variables are, can people actually go to the unemployment office to file first-time jobless claims, or do they have the power to do so online? That's one, which might understate these effects. But then what happens when they have been trying to go to work or jobs have been canceled, especially those that are people that depend on good working conditions because they're outdoors to complete their work. These numbers are going to be kind of erratic, so we'll have to bear that in mind as they start to come out every Thursday. And I'm sure the markets will also kind of take these numbers with a grain of salt. A few things out there. Get used to hearing fiscal cliff, because now after the election, the attention is going to really be on this fiscal cliff. And if you've been hearing this terminology, as we all have, what does this really mean? Okay, so think about this. The GDP for the U.S., the gross domestic product, has been right around 2%. Maybe that even overstates it a little bit. The revisions might come back in, bring it back down below 2%, which is not great. It's barely chugging along. But the fiscal cliff has a few components to it. It means that in less than 60 days, we're going to be seeing an end to the tax cuts under George Bush, which means tax rates will go up. And also there's a payroll tax cut that is a 2% payroll tax cut for the employee. That goes away. And there's other aspects too. What do we do with some mandatory spending cuts? And all these things, according to the experts out there, they think that it will affect GDP in a negative way by the equivalent of about 4 points. So you're saying, okay, even if you say, good, we're at 2 points plus GDP, minus 4 points on GDP means we're -2 overall and we're in a recession. Clearly of concern, and you wonder if the parties can get together to figure out an extension or a fix to this. It'll be exciting and interesting because it won't be great for the economy. Now on the other side, on the interest rate side, probably is another reason that we see interest rates lower or into the future for some time. Speaking of which, there's a lot of talk about Ben Bernanke. Is he going to, if Mitt Romney won, be replaced? Who would Mitt Romney replace him with? Well, now that's not a variable. Under Barack Obama, probably not going to be replaced, but Bernanke has indicated that he's kind of done after his term in 2014. He wants to probably move on. Who would his replacement be? It seems like under Barack Obama, the most logical choice might be Janet Yellen. The former San Francisco Fed president is someone who is much more dovish, perhaps, than Ben Bernanke, making Ben Bernanke almost look like a hawk. So be very pro-accommodative policy. And is that good or bad? Again, who knows? But it looks as if this scenario would play out. Lots more QE, and you can debate what the short-term, long-term effects with that would be. We've talked about that in the past. I'm sure you've been thinking about that yourself. But it looks as if you may have an even more dovish Fed chair on deck. All right, let's go to some of the charts here because I think they're very interesting. So first of all, 10-year note. Now the 10-year note yesterday hit right near that floor we thought it would. Just amazing how this stuff works, huh? So it comes right down towards that floor, bounced higher today. But you see the longer upper wick means it was in worse shape. It's now on the way down. You do have a 30-year bond auction at 1 p.m. Could that stir things up? Of course, we'll have to watch it carefully. I think the stock chart's also very interesting as we look at the S&P 500. And the S&P 500, we did break that floor. We thought we'd go down to 1,400, and 1,400 was broken. It was given yesterday. Today we tried to move back up, hit 1,400, and now it backed off. We're at 1,390 on the S&P now, and when it seemed like we were talking about going to 1,380 towards the 200-day moving average, it seemed so far off when we were at 1,430. Seemed like, probably not going to happen. Well, look at how quickly we've gotten close to it, and now we're only 10 points away from 1,380. I think that we'll more than likely wind up drifting down towards this level. And will we see a similar scenario to here where things turned around? This is a beautiful, what's called a morning star pattern. When you see a big down day, a day of indecision, and start of an up day, and then we had a big rally. It's possible that that could occur. We'll have to keep a close watch on it. And of course, as we know, if stocks continue lower, it means probably good news for bonds in the short term. But if stocks from here muster a rally higher as they did from these levels, good news for stocks, probably not such good news for bonds. Let's take a quick look here and let's bring up the charts as we have been doing. Mortgage-backed securities now up 14 basis points. Looking at our new MBS highway chart, this is a nice move higher, and we are near the highs of the day right here, as you could see. It looks to me as if this floor of support here at the 25-day moving average has been a pretty good test. Certainly the 50-day moving average has been wonderful for support here. It is on its way up, moving higher. Looks to me if stocks behave poorly, as they might drift down towards their support level near 1380 at the 200-day moving average, there's some more room for gains in the bond market. So we're going to say let's go ahead and continue floating. It served us well. Of course, if something changes, we'll be back to you. Hope you have a great day. Bye-bye.